Meeting for August 9th, 2022. Those present been noted?
Yes.
Thank you. Move for the approval of the agenda.
I'll make a motion to approve the agenda.
I'll second.
I have a motion and a second. Any discussion? Hearing none. All those in favor? Aye. Opposed? All right. Approval of the minutes of the regular meeting held June 29th, 2022.
I'll make a motion to accept the minutes from the June meeting. Much better.
Okay, we have a motion and a second to approve the minutes. Any discussion? Hearing none. All those in favor?
Aye.
Opposed? Move on to the bank summary of assets, expense reports for June and July, as well as the quarterly bank statement summary.
So as of June 30th, the market value of the portfolio was about $158 million, a loss of $8.9 million from the 531 balance. Just a few expenses, $30 worth of class action handling fees. And then underneath that, you will see the quarterly bank statement through 6/30. And then I'll move on to July. So as of July 31st, the market value of the portfolio was $164.4 million, a gain of about $6.3 million from the 6/30 balance. And as far as expenses, we just had Comerica Bank's quarterly fees totaling $12,314.91. And then you also have the quarterly bank statement summary starting as of July 1st through July 31st. Let me know if you have any questions.
Nothing here. Okay, I'll look for a motion to accept those reports.
I'll make a motion to accept the bank statement, quarterly bank statement, and the summary of assets.
A second.
We have a motion and a second. Any discussion? Hearing none. All those in favor?
Aye.
Aye. Opposed? Move on to board and administrator reports. I have nothing.
I have nothing.
Tammy, you have nothing? Ed is absent today. Jake?
Obviously, we hired 4, which we talked about last time. We got 1 more starting in 2 weeks, and then I had a discussion with one of the retirees, Chris Love, who had just left the drop, about talking to Comerica about doing a wire transfer versus the paper check. Is there a reason why we only do paper, or they only do paper checks versus wire transfers?
They told me they are not equipped to do wire transfers for our benefit payment arrangement. So it's a third party, and so they're set up to do a third party wire
Okay,
on behalf of another person.
okay. And then it sounded like we had come to an agreement that we were going to overnight. That was kind of the,
Yeah, so we started that process, and then the day that we were getting ready to do that, the check magically showed up where it was supposed to.
okay.
So-
So going forward, we're just going to do.
We're just going to overnight for everyone.
Okay.
Yeah, because we just don't know with the mail how long it's going to take to get there, so,
Okay. That's all I have.
perfect.
Okay.
Is there ever an option for them to pick it up?
Well, it's like when you're rolling over funds, so when you're sending it to another company on behalf
Oh, I
of
see what you
someone.
mean. Okay.
Yeah.
I'm with you.
No, it's my understanding if we're paying them out directly, then you can do a wire. So if they
Okay.
weren't rolling it over, if they were just taking it as a lump sum, then you can do the wire payment.
Okay, all right.
Okay. Chris is absent. Lily, you always have a little something for us.
Yep, so here we go. Dalton Turmel, police officer, was terminated on 6/16. A letter regarding his options for withdrawal was sent on July 1st. We had some new firefighters hired that Jake mentioned, so that was July 18th. We had Justin Holm, Raylan DeGroff, Travis Henley, and Justin Miller. And as we also mentioned, Chris Love exited the DROP program with a retirement date effective July 5th. His benefits and interest totaled $396,789.59. We forgot to withhold the 5% of interest that we retain, totaling $1,014.99. Linda is working with Chris to recollect these funds. It'll probably just be an invoice that he pays. So the full dollar amount was requested to be rolled over to Vantage Point. The payment was issued July 7th. An off-cycle payment was made to Chris dated August 1st for $5,465.17. That's a prorated portion for July, so 27 days. And then his regular monthly benefit payments of $6,274.83 will begin on September 1st. We also had Sean Matheny exit the DROP program with a retirement date effective July 4th. His benefits and interest totaled $386,012.56. We retained the 5% interest earned of $953.51. There was also an early withdrawal penalty of 10%, so we retained an additional $1,907.01. The remaining balance of $383,152.04 was requested to be rolled over payable to Edward Jones. This payment was issued on July 20th. An off-cycle payment was sent to Sean dated August 1st for $5,747.70. That's a prorated portion for July. His was 28 days. And then his regular monthly benefit payments of $6,363.52 will begin on September 1st. And then I also have one resolution for Derek Malone, if you guys would like to look over that.
I'll make a motion to approve the resolution for Derek Malone.
A second.
We have a motion and a second to approve Derek Malone's pension benefit. All those in favor?
Aye.
Aye. Opposed? No. That is approved. Old business, the actuarial valuation.
So I just wanted to put that in writing since we kind of left it a little open-ended at the last meeting. So Linda met with GRS, and after voicing our concerns, she's recommending that we stick with GRS. So we reached out via email to all the board members. You guys all approved that, so we're just going to kind of monitor their progress this year and see if we need to reevaluate this next year. So you guys don't need to make any more motions or anything for this. I just kind of wanted it in writing. Any questions on that?
No, I think we all got the emails and responded.
Okay.
New business.
So you guys all saw the experience study come through in your email. So Linda couldn't be here at this meeting today, but she would like it if you could send me any of your email questions. I know, Jake, you already sent some. The biggest issue being the rate of return. I think you might have gotten an email about that too. So we kind of just want to compile all our questions so then we can actually make some decisions about that experience study at the September meeting. I don't think her plan was to have GRS at that meeting, but depending on the types of questions you guys have and how they answer it between now and then, that could change. If you guys would all prefer them to be there, just let me know and I can talk to Linda about it as well. So I didn't know if you guys wanted to talk about anything having to do with the experience study today, or if you want to hold off.
I personally would prefer to, we got the draft copy. I know that Ed will probably have some questions, and Chris may also. So we just table that till the next meeting as was recommended, so that Linda's here. But review it, submit your questions to Lily.
Will you voice the questions that everybody emailed you?
You can. Once I get emails from everyone, I could do like a compiled email, so you can
Yeah.
all see what
That'd be
each other's
helpful.
questions
We're not
were.
asking the same questions.
Yeah.
Yeah.
I think that would work best. Okay, I guess I'll look for a motion to table that till next meeting.
Perfect.
Guess I'll make a motion to table the experience study questions until the next September meeting.
Okay, I'll second.
Motion and a second on the floor. Any other discussion?
So when we, obviously want to change some of our assumptions in here, and we've already granted GRS the actuarial evaluation. So the changes that we make in the next meeting, we'll have to get to them because that's going to affect how they do our evaluation report coming up.
Yes, I believe we would want those incorporated in this next valuation.
Okay.
Right.
All right.
Okay, we had a motion and a second. All those in favor?
Aye.
Aye. Opposed? Policy review, the disability retirement.
So all I had as far as changes for that were just a couple grammatical things, but I didn't know if there was anything else you guys saw in there pressing.
I didn't see,
Wasn't
I got
attached
that.
to ours. Any of the changes that you had sent wasn't in the
Oh, it didn't
attachment
show
that I
it?
got, just the copy that was on our website.
Yeah,
Oh,
I
okay.
didn't get a copy of that either, so.
So
It's just some
it's just grammatical stuff, like the first one was just shortening a sentence because it was a little
oh, there it is.
difficult. The workers' compensation, I just moved where the apostrophe is to keep it consistent with like how the federal government has it listed on their website. I don't know if you can see it on the big screen or not in front of you guys. So the red is stuff that I either put in or took out. So really, it's all grammatical. I didn't do anything with like the actual policy itself.
Right.
Oh, that one, the word was just in there twice, so I took it out. That was it, though.
pretty much just cleaning it up. I don't even know.
Yeah.
if you need a motion to approve it. You just note that it was reviewed on this date for grammar. Yeah, for Scribner's errors.
Right.
Is that okay with everybody?
That's fine.
Yeah? It's nothing, no major change to the policy, or any, really. Jeremy?
Good afternoon, everybody. So I'm going to focus just on the agenda, page 1 of the iPad. We'll give a review of the economy and capital markets, which has continued to be anything but boring. But we've, as a silver lining, it's been a solid couple weeks from a return standpoint. We did bring the second quarter quarterly report, which we'll take a look at, give a very brief current portfolio update, although really Lily just did that. You saw a slight increase, about $6 million in assets going through August 1st, and then action items for the September meeting, which obviously a big one will be talking about assumed rate of return and the actuarial report. So on your iPads, I'll go ahead and skip to page 5. And this shows different index returns for the second quarter, which is represented by the bars with the white diagonal lines in them, as well as year to date. So in other words, the first 2 quarters, which is represented by the solid bars. I'll focus on these tan bars first. So just in the second quarter alone, large cap stocks represented by the S&P 500 were down over 16%. So very poor quarter for large cap stocks, and really you could see across the board, regardless of what types of stocks we're looking at, we're fairly consistent with that. All the way to the left, the red diagonal bar is U.S. small cap stocks, which were down over 17% for the quarter. You can see for the year, large cap down about 20, small cap stocks down over 23. When you look all the way to the right, commodities are still substantially positive year to date for the first 2 quarters, although they were down on the second quarter as well, based on oil prices starting to come down essentially since early June. So we'll kind of peel back the layers of the onion to talk about why we're seeing the capital market returns we are, or at least how they tie to the capital markets. So page 7 just shows you a illustration by sector. So again, I had hit on oil prices, and energy in general would be the real silver lining of the last 12 months. Energy stocks are up over 39% for the year. Year to date up over 31%. And so when we talk about in the investment world, value-oriented mutual funds or investments typically have exposure to energy, and they've typically done better than growth-oriented investments. You can see pretty much across the board everything else was negative, although for the last 12 months, consumer staples and healthcare, consumer staples would really be more conservative companies, like a Procter & Gamble per se, is still slightly positive. Page 8, now we're going to talk more about the fixed income world or bonds. A big theme continues to be within the second quarter is rising interest rates, especially because the Fed has continued to make moves to raise the Fed rate in order to control inflation. So if I look at the very top left of this page here, you can see the end of the first quarter interest rates, and then the end of the second quarter. The 3-month interest rate was up quite drastically. You can see from 0.52% to 1.72%, and that's really a reoccurring theme all the way out to 30-year interest rates. And a big one is the mortgage rates. So you can see average mortgage rate for a 30-year went from 4.9 to 5.83, so that's obviously quite substantial. That's tying to some of the concerns within the economy as, home sales had continued over past years to sell at record rates. There's been a very high demand. Now with increasing interest rates, is that sustainable and going to continue? And I'll actually show you a slide dedicated to that. Page 9 gives you headwinds and tailwinds. So really the headwinds are what has led the negative effect on the market. Instead of reading these bullets, I'm just going to show you a couple slides that tie to them. So for example, it says inflation fighting hurdles there. We'll just turn the next page to look at that. And that bottom left blue bar shows the increase in inflation, or in other words, rising prices since early 2020. And you can see the rationale of it's a common question to a lot of our boards or committees, what's driving that inflation? Because it's multiple factors. You can see on the left in blue, geopolitical tensions make up estimated about 40% of inflation. Or in other words, the Russian invasion of Ukraine, and I showed a slide last month, certain products that's really hurting, like fertilizers, for example, and obviously oil prices in general. The COVID-19 pandemic has created supply chain distribution disruptions, as well as labor market dynamics. And then demand-driven inflation, and what I mean by that is coming out of the COVID environment now, there's more of a demand for travel, there's more of a demand for cars, and a lot of different products out there, which typically will drive prices up as well. So why is the Fed making moves to raise interest rates like they have 75 basis points at their last meeting? It's really to control that inflation. The market even today is a little bit shaky, and that's really ahead of tomorrow's inflationary CPI report to see how much prices have risen here in the short term. Page 11, I'll just keep some of these high level, but again, wanted to give you a feel of what's challenged the market. Consumers have become more under pressure, and what I mean by that is that chart on the right shows your average mortgage payment and how that's really increased drastically since 2017. You can see the average during that time was just over $1,100. It's almost $2,000 now, and again, that's because you've got these rising interest rates for new home buyers when they're purchasing existing homes. So is that sustainable when you're talking about higher energy prices, high oil costs, and just inflation in general? And then page 12, a negative wealth effect for your average consumer. On the left just shows how personal savings rate really spiked in 2020. People weren't traveling as much, right? There was obviously stimulus that was given by the government during the pandemic environment. Now that's really come down quite a bit as, again, the demand for spending money has increased, but yet at the same time, when you look at the right, obviously the lost market cap of your average investor's savings is down about 40% if they're invested in stocks, or in other words, represented by the Russell 3000. I would argue these numbers are endpoint sensitive, so we wouldn't expect that chart on the right to continue over the long term, of course. There's definitely been a substantial market correction. But it just, we were talking about how strong personal balance sheets were about a year ago in our meetings. Now we're talking about a little bit the opposite just because of some of these factors that happen quite quickly. Page 13. I want to give you a little good news on a valuation perspective. We see, as of May, valuations being fairly strong. So over 500 companies in the Russell 3000, I won't get too far into the weeds, but basically had very attractive valuations. They had price to earnings ratio that were below 10. That's only happened 7 other times, going all the way back to 2002, and these times are representative by the kind of these navy blue bars. So all the other times that are in the light blue bars, that's when there wasn't at least 500 companies with that attractive evaluation. And when you look at the table on the bottom left, that shows returns that we've seen historically when we've seen attractive valuation environment like this. So for example, 2008 was really the only time period we didn't see a substantial bounce back over 2 years. The market was up about 4%. But you can see all the other, December 2008, 2011, 2018, 2020, very substantial 1 and especially 2-year bounce backs. So valuations, when everybody's ready to run for the market or ready to sell, typically in many environments it's time to buy. That's why we rebalance within the pension plan. That's why we want to stay disciplined with the strategy. Typically you have an environment that is ripe for returns. And then page 14 just shows kind of more of that data in a different way. So if you look on the table on the right, it just shows consumer sentiment, or in other words, how confident consumers are. Typically and right now we're at a 50 for consumer sentiment, which is in the bottom third of what we see historically. Typically when consumer sentiment is in the bottom third, the 3 and 5 year forward average for market returns also is higher than historical. In other words, we've kind of already seen the pain of which made consumers a bit less confident and have less sentiment. Now going forward, there's definitely room to grow. So valuations, consumer sentiment, a lot of the numbers are attractive. We're not a firm that tries to time the market, but what we can do is look at history, especially in these difficult markets, and see where there's opportunity. So I will pause there on the market and economic update, and then we can just go to the actual Battle Creek Police and Fire numbers. All right, so let's go ahead and skip to page 19. You should see it says asset allocation in the top left, asset allocation summary. On the bottom right is the table that shows the targets for the pension plan for cash, which is about 3%, bonds 42%, and then you've got U.S. and international equities, which come to 55%. No needed rebalancing at this time. We've raised the appropriate amount of cash in prior meetings, which actually did some natural rebalancing in order to capture some of the asset classes that did a bit better. Page 20, just the very next page. Again, the total asset value as of June 30th was $158,078,049. And as Lily initially alluded to, now about a month later, the portfolio's up about $6 million of $164 million, and obviously we'd like to keep that momentum. Page 21 shows the returns, and keep in mind this is a 55 stock, 45 bond portfolio, but again, bonds have performed poorly, and we showed you a whole chart of that last meeting, which was about a month and a half ago. So the total portfolio outperformed the benchmark, although it was down about 10.5%. That would be one of the worst quarterly returns for what we'd call a balanced strategy historically when we look back. And then year to date, the first quarter wasn't very good either. You still look at the 3, 5, and since inception numbers, outperforming the benchmark, but now, these numbers tend to be endpoint sensitive, now more to the 5.5% range. We would expect at some point a pretty healthy bounce back compared to some of the numbers we're looking at, which, again, obviously been a very difficult last 6 months. And page 22, just the very next page, shows exactly that. So except cash, which is represented by that very top bar there, whether we're looking at bonds or bond indices or stock indices, you see a lot of negative there for year to date. 22 over the last 6 months. Bonds would be negative, but not as much as when you go to the bottom of the page or the next page as stocks. There's really just been nowhere to hide due to interest rates rising, making bond prices fall, as well as the concern around the equity markets, which I highlighted in the economic update. So year to date, the portfolio down about 15.89%. Last quarter down just over 10.5%. These numbers have bounced back again in July and early August so far, but we try not to judge a portfolio by that short of a time frame per se. So I'll go ahead and skip to page 29. And this, as a reminder, we call this the investment policy statement monitoring summary, where it takes each investment and looks at both quantitative and qualitative data and gives it a score. So if a fund is 80 or above, we just mark it in green in good standing. If it's between 70 and 79, we mark it for further review in yellow, and then below 70, we'd mark it in red. And the report does go to page 30 as well, as far as that color coordination. There are 2 funds that are marked for review, 2 funds that we did indeed talk about last quarter, and there's commentary on page 32 for both of them. Really, I'll allude to, there's no recommendations to replace managers at this time. The managers that we've marked for review, we just feel fairly strongly that their style has been a bit out of favor. So Goldman Sachs Small Cap Value is there in the middle. It just essentially goes through, they've got 2 co-portfolio managers that have been there a very long time. They've navigated small cap value throughout various market cycles. They have been punished specifically in late 20 and 2021, that higher quality names that they've held have been out of favor. These have held up a bit better from a volatility standpoint in 2022, but we obviously want to see them get back on track when their style is back in favor and as expected in order to maintain that conviction. And then PIMCO Low Duration, I won't hit on that commentary. I'll actually just go to their fund fact page, which is on page 35. So why are they typically marked for review? We talked about this. We really like how PIMCO Low Duration pairs with Loomis Sayles fixed income. PIMCO is meant to have less sensitivity to interest rate changes, and I'll show you that has definitely been the case here in 2022. But its 10-year return, you can see just over 1%. We are not looking for them to have these big substantial returns. We like how they pair with Loomis because they tend to be a bit more aggressive, both from a quality and a duration standpoint. So year to date, PIMCO would be down 4.3%, putting them in the 41st percentile, even though interest rates are up quite substantially. If you just flip 2 pages to page 37, you can see Loomis year to date's down about 10.5%. And again, Loomis has really performed as expected. You can see their 5 and 10-year numbers, very, very strong. But we like how low duration pairs with them because low duration tends to be less sensitive to interest rate risk. And that's why they've outperformed Loomis by about 6% so far during the year. So again, no recommendations for change. It's been a very, very unique environment because typically when stocks are down so far, bonds give that cushion, and we just haven't seen that due to the unique interest rate environment. So I will pause there. I know a lot of talking, but see if there's any questions. All right. And then last but not least, page 50, there's really nothing noteworthy to hit on this other than it backs up what you just saw in the asset statement in the top left. As of August 1st, we have seen a nice little bounce back of the plan being over 164 million, and hopefully we see that continue. Great. That is all I have on our end, unless you have any questions.
What do you foresee the future here?
I think valuations are attractive, Stan. So I'm not I always try to avoid the crystal ball conversation, but I think many things that are concerning with the market going forward, whether it's inflation or consumer confidence, has been priced in. So we also feel interest rates can only go up so much. I mean, for a long-term bond investor, rising interest rates is good. It's painful in the short term because it makes your bond prices fall, but these managers don't have to take as much risk to get some kind of return as we've seen them in the past. So From a valuation and consumer sentiment standpoint, I think the rest of 22, whether it's 2022 or 2023, I think there's some nice growth potential.
I know there's a lot of discussion with the bills that pass in Washington, how that's going to affect inflation
Right, right.
and everything.
Right. Well, and just the unpredictability, candidly, of the Fed and how much they're going to raise rates when we're talking about, I don't know if it's concerning level right now, but again, your average mortgage payment for a new home buyer has increased $800 from just less than a year ago. So is that sustainable, you know? At the same point, when a lot of the stimulus and a lot of the pent-up demand, people aren't saving as much, so. And it's hard to get a car, right? When you can get a car, they're expensive, and then when you have to fill up that car, it's expensive. But again, I think a lot of that has been priced in, at least historically, that's what the valuations have said.
Okay.
All right.
Jeremy, do you still think that our blend of 55 stock, 45 bond is still appropriate, or should we look to sway it either direction at all, a couple points here and there, or?
We continue to feel 55 stock, 45 bond is appropriate. I think what we're going to look at next meeting is that whole actuarial report, and they say, okay, your assumed rate of return 6.5. Gabriel Roeder feels very strongly about 6, which, by the way, a lot of our numbers would agree with from a hypothetical standpoint. So what we'll look at is you could move more aggressive to achieve that 6.5. You're just going to have to take a ton more risk. And typically, we'd say with a pension system such as yours, that wouldn't be a trend, you know, just because of the volatility we've just seen, and then that obviously affects the funding of the city or anything else. Yeah.
That's kind of the two-edged sword.
It is. And at one point, I would have to pull up, I know, Stan, you're involved with this, the city did go from 50 stock to 55 stock, so a small incremental shift. But again, the more you do that, and we have a down market like this, I mean, we've got some private clients or companies that are 65 stock, 35 bond based on their financials, and as you can imagine, they're hurting quite a bit more just from a funding standpoint. And not to blab on about that, but as a caveat, and Gabriel Roeder would say this, when interest rates rise, it does make liabilities fall. So there is a silver lining. Although your bonds are down in your portfolio, from a liability standpoint, that cancels some of that out. So just to keep it in mind, I think sometimes we just look at asset returns and think, okay, that's down, but rising interest rates can be good from an actuarial standpoint.
Okay,
All right? Good to see everybody.
thank you. So we move on to public comment. Next meeting is scheduled for September 19th. You said Chris may have a,
Chris had a conflict with that week, and Linda would prefer us to meet as early as possible in September so we can nail down the experience study and get that figured out. So Chris said any time in the first 2 weeks of September would work for him, and I don't know about Ed.
first 2 weeks, I'm pretty much open.
I just have a vacation day on the 16th, but
On the 16th.
I'm available any other.
Yeah, well, the 9th, I'm tied up.
I've got 6, 12, 13, 16.
You're no good on the 6th?
I can do 6, 12, 13, or 16.
I'm trying to coordinate with Linda's schedule here, and the 6th, she does have a meeting from 1:30 to 2:30, which is the same time we meet. So I think it'd probably be beneficial to have her here for that one.
Yeah. I'm available all day on those
Okay.
days too, so if we just need to switch the time slot, I can make that work.
And it looks like she's unavailable on the 12th and 13th.
Yeah, that's what it looks like.
We could do it 10 in the morning on the 6th, if you're off that
Yeah.
full day.
Yep,
That work for you? Works for me. I know that the clerk, when we were trying to schedule meetings for the compensation committee, list the names and then send out some times, and you could color in what worked and what didn't work, which is a handy little device.
That would be, I can check.
Or
I
you could
did
just
reach.
do it by email with those two, though, I guess.
Yeah, I'll double check with them. I did reach out to IT about getting a calendar set up, so we'll see how that goes. I don't know how it works with people that don't have city emails. That's the only hang up.
yeah.
Yeah. So that's a work in progress, but
Does that day work for you, Jeremy?
It doesn't, unfortunately. I have a client meeting that morning. I could definitely check with Dory.
Yeah, we haven't seen her face in a while, so.
Exactly. Which I just don't know. I would have to coordinate with her, but.
Feed Justin to the wolves.
What's that?
Feed Justin to the wolves.
Justin's in Raleigh now, actually. He lives in Raleigh.
Oh,
Yeah.
okay.
Still involved with our team and does investment research though, so, yeah. Maybe the virtual wolves. but-
We want to tentatively put down the 6th then at 10
Yeah.
o'clock?
Because we threw out the 13th to maybe make in the morning, correct? But that doesn't work for Linda, is that what we said?
yeah, she's
Okay.
busy all day pretty much.
Got it.
I would like to have her here.
Absolutely.
Yeah.
Yeah.
Got a September 1.
We could do that, we just won't have any August numbers yet, as far as the bank goes.
That's same with.
Yeah.
Okay.
You said 16th?
I have a 16. Yep.
I know it's pushing it towards the end of the first 2 weeks.
You said the 16th? That's when I'm off.
Oh,
That's the only day.
That's right.
I have a 15. It looked like it was blocked off, but it's not.
I can check with Dory on the 6th. But,
I don't see anything on Linda's calendar really for the 15th. So she would be good that day too.
You said it was not good for you.
15 I can do.
15th? It's the day before you take.
What about you?
I also have a client meeting that afternoon, but I can check with Dory on both of them.
Well, I guess we could send out an email, see what works better, the 6th or the 15th.
That's
Okay.
fine, yeah.
Dory,
That
and
sounds
then
good.
6, it'd be early on the 6th if we do it, or it'd be
Yeah.
on the 15th at our normal.
Yeah, either September 15th, 1:30, or September 6th, 10 a.m. I'll send out an email and we can
Okay.
decide.
That works for me.
Would the morning of the 15th be available at all?
Yeah, yes, for me.
Okay. 'Cause
Yeah,
The
this for
only thing I
me.
couldn't do is the afternoon. It looks like I have a client meeting, so.
Yeah, we could do 10 o'clock on the 15th, if that works. Let's look at it that way.
Okay, great.
Then if you check with Chris and Ed,
Yep, I'll check with them.
see what's the best and advise.
Sounds
But
good.
that- If we can do it on the 15th, that would work out good. Cool.
It's always tricky. We have a day a month blocked off for boundary, but we usually just can't. Doesn't work for
It doesn't line up.
Yeah.
Okay, if there is nothing else, we'll adjourn the meeting.